say, all right, you've set up this game where banks are allowed to create 10 times as much credit on their books as they have capital, actually 12 times their capital.
Amazing.
So we're going to set up a state-owned bank. Now, our state has enormous amounts of capital, way more capital than your average private bank, and even probably even than your huge private banks. California has $62 billion in investments, which is a very interesting thing in itself. What are we doing with all this money socked away in investments when we're supposedly $27 billion in the red? But anyway, we have $62 billion in investments. We have $200 billion in real estate owned by the state. Plus, they have something like, I think it's 120 in revenues, annual revenues. So they have a lot of money. If you took all that money and you used it for the capital base for a bank, I calculated you could have $4 trillion in loans.
That's amazing.
But of course, you're not going to use it all for. But let's say you took that $62 billion that you have invested, and say you took half of it, $30 billion. You could make $300 billion in loans. That's enough credit to refinance the whole state, all the state's debt. So you'd be paying 0% interest since you'd be the bank. I mean, you'd get the interest bank back, and you could put all those people back to work that need jobs. You could refinance all those homes. You know, you could buy those mortgages off the banks, so you'd clean up their books so they could make more loans. And meanwhile, you could do some sort of workout with the people living there, or rent it back to them, or whatever it takes to get this whole machine going again. And you would still have lots of money left over to do alternative energy systems. We need a good high-speed train between LA and San Francisco, for instance. I mean, there are many things that we need, and the only thing we're lacking is the money. But the money is only a medium of exchange. It's only a receipt. It's the grease that makes things work. We've got the machinery, and we've got the people, and we've got the brains, but we don't have the grease to put them all together. And we can create that just in the same way that private banks do it, but the private banks are withholding it from us.
How many states in the U.S., we're now in December of 2009, how many states in the U.S. do you think are either on the verge of bankruptcy, bankrupt, or are in trouble?
48 out of 50 states will be unable to meet their budgets next year, or having trouble meeting their budgets. So I don't know if you call that bankrupt. You know, a state is not allowed to go into debt. That's the problem. But they really should be. The federal government is $12 trillion in debt, and they're still going strong. So a state should actually be allowed to operate on credit, just like the federal government does. But anyway, technically they're not, and so you just call that bankrupt because they can't meet their obligations. But as I say, all states have these huge investment pools that they don't touch, that they could actually use. So states have a lot of assets. I mean, they're not really going to go bankrupt. California says right in its state constitution that it can't go bankrupt. So you don't have to worry about that. I mean, they'll just overtax if they have to, or sell off all their state's wares or whatever. But they are definitely in the red. They can't meet their budgets. 48 out of 50, and one of the two that can is North Dakota, which has its own.
Talk about that briefly, even though we covered that in length on the first interview. Give a context and a brief overview on the Bank of North Dakota.
They set up their own bank in 1919 when the farmers were losing their farms to the Wall Street bankers. It was the very same situation that we have going on today. And they were tired of having their money go out of state, so they decided they were just going to keep it in state, and they would set up their own credit system with their own central bank. So by law, ever since then, all of the state's revenues have gone into this bank, the Bank of North Dakota, and so that becomes the deposit base for many times that sum in loans, and they can use that for they in their state charter they have a certain mission, which is to help the farmers, to help state development. So they use that money specifically for development. They do things like they have a very good student loan program. They give 1% loans to farmers, and they actually partner with the other banks. So the other banks like them. They're not don't feel competitive. But what they do is they take loans off the books of the other banks, so they're serving the role that the investors used to serve for our banks until the investors when they realized that this whole collateralized debt obligation was a scam, and they all went away, and that's why the banks are stuck with their bad loans and they can't clean up their books. But in North Dakota, the central bank, the Bank of North Dakota, buys up those loans from them and makes room on the bank's books for more loans. So they sort of backstop and provide funding for the other banks.
I have a question that I asked you in the first interview. Since the issuing of money is done on an electronic system and it's a liability system, how is it that there's really ever any debts when it comes to depositors and repayments? If they can create for every dollar $12, isn't it a falsity that banks are really ever in debt in that context?
Well, it's all on their books, and they do have to balance their books. That's the catch. They can create as many loans as they can get borrowers. They're not limited at all in the amount of loans they can create. It used to be they were limited by the reserve requirement, but now that's pretty much obsolete because they've figured out how to get around it. But where the limit comes in, let's say you create $1,000 of loans on your books. Let's say you've got $100 in your capital, and you create loans on top of that worth $1,000, and so that will create an asset for you. So now you've got $1,100 in assets, and you've also got $1,000 in liabilities because that money goes into somebody's checking account and they can draw checks on it. So that's a liability to the bank.
I get that part.
Okay, now if that loan goes bad, as long as the bank can call that loan a paying loan, they've got the asset. Even if the guy doesn't pay, that's why the banks are hanging on to all these bad mortgages and they're not foreclosing because they don't want to write them off their books. But if they have to write that loan off, so now they no longer have that $1,000 asset, but they still have the $1,000 liability. So now they're bankrupt because they don't have the assets to balance their liabilities.
But what about the other 11,000 they just created out of thin air? What happens to that? So let's say they lose the $1,000 from, let's say, me, a depositor, right? Let's say I can't repay my $1,000, but they just took out another 11,000 to do business, right? They could take out up to another $11,000, right, or $12,000 based on my $1,000. Is that correct?
I guess I missed your.
Well,
if you walk into the bank with your $1,000 and you put $1,000 into the bank, yeah, they could create 10,000, well, 9,000 in loans on top of that.
Okay, so let's say they create 9,000 in loans. I mean, they're basically creating a massive financial machine by that capacity. True,
but they've not only created an asset for themselves, they've created a liability for themselves, and that's why they can go bankrupt.
Okay.
It's like if you make a loan to Russia and Russia defaults, you're bankrupt.
Okay.
If you don't, so even big banks can go bankrupt because they make very big loans.
In the article, there's a section of it called "Making the Creditors Whole," where you talk about if a debtor nation refuses to pay, the burden shifts to the creditors to make themselves whole. You talked about the first option is to remove the obligation on banks to maintain parity between assets and liabilities. Do you remember that?
Yeah, I was quoting a man named
Michael.
Yeah, Michael Robotham in England.
Yes.
And so he's saying that because all debt is just created on the books of banks, if say you had some overarching institution that, like a bankruptcy court, an international bankruptcy court, and the debtor goes into bankruptcy court and says, we just don't have the money, then the court should say, all right, the way we're going to resolve this is we're going to allow that bank to carry that bad debt on its books. So it's just like when we were talking about if you took out $1,000 mortgage and then you didn't pay it, I'm going to have $1,000 hole on the asset side of my books. But if the bank says, all right, you don't have to pay it because you don't have the money, and we understand,